Welcome everybody to the Physics of Investing. In today's video, we're going to be analyzing Lemonade stock, ticker symbol LMND. Now we have a lot to talk about, so I'm just going to go ahead and get right into it. I started off this analysis by creating a business model thesis. Now this business model thesis basically contains all the major parts of the business model and combines it into one sentence describing the company. Now the business model thesis for Lemonade is as such. Lemonade is attempting to grow into a large-scale and highly profitable global insurance company through convenient and clever marketing and branding by leveraging and growing their proprietary technology and by attaining strong retention rates through a subscription-based model. Now here's a little diagram that kind of explains the business model thesis and also explains their business model in general. So their attempt is to delight the consumers in order to grow fast. And the faster they grow, the more predictive data they get, and then the machine learns. And this kind of just spirals and goes around in a circle. So then they delight more customers, they grow even faster, they get even more data, and the machine learns even more, and it just continues to build on itself and becomes a better and better system. So the first part of the business model thesis that we're going to unpack is the convenient and clever marketing and branding. So Lemonade is attempting to make insurance fun and relaxed. You can tell this by the bright colors that they use on their logo, as well as the neat cursive. The name and Lemonade itself just has kind of a feel-good connotation. They also try to make Lemonade insurance convenient through speed. It only takes 2 minutes chatting with their bot, Almaya, to get covered through renter's insurance. And claims are paid by another bot, Jim, in as little as 3 seconds. So you can see convenience and speed is a core part of building their brand. And that way they can attract a lot of customers, especially impatient customers such as younger people who have got a lot going on. They don't really have time to sit around and read an insurance document. They're also their app and their website just are like neat, state of the art, more appealing to newer generations who are more accustomed with online and websites. And they also have a give back feature, and this is a part of building their brand. What they do is they donate leftover money to causes their customers care about. And basically the customer can choose through a pre-vetted list of what charities it wants the extra money to be donated to. This is after all the claims are paid by Lemonade. And all that extra money is going to go to those charities. So here's a little chart of the different types of AI that Lemonade has. It has Almaya, which is our playful onboarding and customer experience bot, sells our policies and handles everything from collecting information and personalizing coverage to creating quotes and facilitating payments. They have Jim. Our claims bot handles the first of loss for 96% of claims as of September 30th, 2020, and approximately a third of cases can manage the entire claim through resolution without any human involvement. They have CX.ai. Our bot is built to understand and instantly resolve customer requests without human intervention. About 30% of all customer inquiries are handled this way. They have the Forensic Graph. Our Forensic Graph platform utilizes the combined power of behavioral economics, big data, and AI to predict, deter, detect, and block fraud throughout the customer engagement. Then there's the Blender. Our insurance management platform facilitates robust collaboration among our customer experience, underwriting, claims, growth, marketing, finance, and risk teams. And lastly, I have Cooper. Our automation bot handles complex and repetitive internal tasks to drive efficiency across our organization. As you can see, Lemonade has a lot of AI, and these AI can keep employee count down by handling claims themselves. They can improve to understand requests better, and they can just overall improve the efficiency of the business by using less manpower. Now, the next part of the business model thesis we're going to talk about is retention rates. So we've talked about how they market cleverly and how they gain customers, but how are they planning to keep those customers? Well, Lemonade plans on having strong retention rates by appealing to the next generation, like I was talking about in the branding and the marketing, and they plan to grow with their customers, right? So as the younger generation gets involved with insurance, they plan to stick with them as they rank up through renter's insurance, into homeowner's insurance, into life insurance. And basically their plan is to capture masses of people early and then ride with them over time and grow with them. And as they do that, their platform is going to increase in size, scale, as well as efficiency because their AI is going to learn more and more with more customers. So over time, as the customer grows and gets more insurance, the platform should grow as well and become more efficient, more friendly, and more reliable. Now, moving on to becoming a highly profitable company, which is the other part of the business model thesis. So we talked about the marketing and branding. We talked about having strong retention rates. Now we need to talk about the profitability, because supposedly Lemonade is going to be one of the more profitable insurance companies because it uses AI and bots instead of employees. So Lemonade plans on being more profitable than your average insurance company by being more capital efficient and using AI to replace employees. Lemonade also uses reinsurance to maximize capital efficiency. We're just going to talk about reinsurance really quickly. So under the proportional reinsurance contracts, which span all of our products and geographies, we transfer or cede 75% of our premiums to our reinsurers. In exchange, these reinsurers pay us a ceding commission of 25% for every dollar ceded. In addition to funding all the corresponding claims, i.e. 75% of our claims. This arrangement mirrors our fixed fee and hence shields our gross margin from the volatility of claims while boosting our capital efficiency dramatically. These requirements tend to be more onerous for younger companies experiencing rapid growth, such that without reinsurance, we would need to reserve as much as 50 cents for every dollar of premium sold, known as a 2-to-1 ratio. Our proportional reinsurance structure shifts most of that surplus capital requirements to the reinsurer, such that the capital surplus requirements for the company is expected to be approximately 7 to 1. So basically, Lemonade has insurance for its insurance, right? 75% of Lemonade's customers' premiums are paid to another insurance company. That insurance company then gives 25% of that 75% to Lemonade as a fee, and then they cover the 75%, the claims made by those 75% of customers. So bottom line is the reinsurance keeps margins stable, and it maximizes the efficiency of a company such as Lemonade. So now that we talked a little bit about the capital efficiency in reinsurance, we're going to move into the gross loss ratio. What is a gross loss ratio? Loss ratio is used in the insurance industry representing the ratio of losses to premiums earned. The loss ratio formula is insurance claims plus adjustment expenses divided by total earned premiums. For example, if a company pays $80 in claims for every $160 in collected premiums, the loss ratio would be 50%. So loss ratios are used to measure the profitability of insurance companies. That's why it's really important to look at the loss ratio when we're talking about Lemonade, because they are indeed an insurance company. So if we look at Lemonade's gross loss ratio, we see that it's sitting at roughly 72% and has been consistently dropping over time. But when we compare that loss ratio to a company like Allstate in the same quarter, we see that their property and casualty loss ratio is 65%, which is 7% lower. Now, to do this, we're going to divide the property and casualty insurance claims and claims expenses by the property and casualty insurance premiums. We're going to get about 65%. And another fact, so we just used one example to see, kind of just compare the gross loss ratios, and we saw that Allstate is more efficient than Lemonade. But if we look a little deeper and do a Google search, we see that the average loss ratio for property and casualty insurance typically ranges between 40% and 60%. Now, this information is from Wikipedia, so take it with a grain of salt. But we saw that a larger company, which is obviously going to be more profitable because they're more established, such as Allstate, has a loss ratio in the 60 percentage points, which is consistent with this Wikipedia source. So I feel like if we really want to see some great profitability from Lemonade and some more efficient profitability from Lemonade, we're going to need to see them drop below 60% in terms of their loss ratio. So now we're going to talk about some of Lemonade's products, because they don't have all the insurance products right now, so they can't get into all the markets and access the entire total addressable market. So far, Lemonade has renters, homeowners, and pet insurance. Most recently, they disclosed that in the next several weeks, they're going to be launching their life insurance, which is kind of the next step to their program. See, we talked about how Lemonade wants to grow with their customers. Well, right around the same time you move into a home and get homeowners insurance, you might need to start thinking about life insurance, because you're getting a family, and so people were more likely to need life insurance. Now, I looked through some reviews of Lemonade's products. If you want to go to Think Insurance, he has 2 reviews on Lemonade Insurance, and he kind of compares the different prices, and I really suggest watching those. That's the source that I use. And if you watch those, you're going to see that Lemonade is very competitive when it comes to renter's insurance, But for something like homeowners insurance, they're not nearly as competitive. And I can kind of understand that because renters insurance is Lemonade's flagship product, so they need to be competitive there. But if you watch his videos, you see that the homeowners prices are a little bit expensive. But I'm sure that'll improve over time with the AI. But for right now, it is not as competitive as someone like a State Farm or an Allstate or USAA. So lastly, we can talk about the total addressable market. This is probably the last main part of the business model thesis, and then we're going to get into some of the financials and talk about estimates that I made. So the total addressable market for the global insurance market is valued at $5 trillion. No single company has more than 4% of this market. A lot of the largest global insurance companies do revenue in the hundreds of billions of dollars, around 100 billion. And so known companies such as Berkshire Hathaway, they've done about $254 billion in revenue most recently. State Farm does around $60 billion. And American International Group did $70 billion. And I think these numbers are from 2019 or they're very recent. Anyways, so it's safe to say that the market is pretty massive and Lemonade has a lot of room to grow. But they also have a ton of products to launch. They're not in all the products like auto insurance, which is huge. They're not in that yet. And they still haven't really actually launched life insurance. Now, if we take a look at Lemonade's balance sheet, it's a pretty good balance sheet. They have roughly a 4x between total assets to total liabilities, and they have $575 million in cash. So they got a lot of cash, they got a lot more assets and liabilities. They look like they're in a strong financial position. Now, if we go to the last couple years and look at some of the numbers they've been doing, we see that the revenue tripled, which is really good, but their net loss also doubled. Now, we saw that their gross loss ratio was improving, and their revenue is outgrowing their net loss growth. So that I would say is a path to profitability. Mainly the gross loss ratio decreasing over time. I see that as improvements, but it did spike up back to 72%, but we're just gonna have to see where that falls. If it keeps dropping and gets into the low 60 percentage points, that's definitely a good path to profitability. If we look at their last quarter, the revenue numbers are gonna be misleading because Lemonade didn't get into proportional reinsurance until effective at the beginning of last quarter. So what happened was their revenue and gross margin flipped, as you can see from this picture. So the revenue numbers are going to be misleading. So we're just going to take a look at the loss and check that out. So they lost about the same between the two quarters, and their revenue dropped a little bit. But like I said, we're just going to kind of block that out because of what happened with their gross margin and their revenue since those flipped. To value this company, we're going to do some estimates. Now, we know using revenue numbers is ineffective because of the switch between gross margin and revenue that occurred when Lemonade switched to doing proportional reinsurance. So what we're going to use is gross earned premium. Now, if we look at the numbers in the last quarter, we see that Lemonade generally brings in about half in revenue as they had in gross earned premium. So we're going to use that same application with our 5-year estimates. If we look at the guidance for 2020, the gross earned premium should be between $154 million to $157 million. And if we look at some of the growth numbers for gross earned premium, between 2018 and 2019, it grew 198%. And between 2019 to 2020, it will have grown 104% if they hit that bottom end of their guidance, which is what we're going to use as a starting point. So what we're going to do is we're going to start with the $154 million, which is the bottom end of their guidance for 2020, and we're going to grow that 80% for the next 5 years, every single year. Now that's really bullish, I'd say, because as you can see, they dropped from 154% from 2018 to 2019 growth, and they dropped that down to 104% between 2019 to 2020. So we're going to drop that down to 80%, but then we're going to run it for the next 5 years and assume that's about the average. So starting with gross premium of $154 million, and we grow that by 80% for the next 5 years in a row, we get $2.909 billion in gross premium. Now, we know just from looking at the numbers, and this is a rough estimate, that in revenue, Lemonade can bring about half their gross earned premium. So if we cut that gross earned premium in half, we're going to get $1.454 billion in revenue. Now, that would give Lemonade, with its current market cap of about $8.4 billion, a price to sales of 5.7, okay? Now, I always want to be in a stock that can 2x in the next 5 years. So we're going to pretend Lemonade stock also 2x's during this time. And that's going to bump their price to sales up to 11.4. Now, we need to do some comparisons. We should look at some other insurance companies to see how this stands out. If we take a look at some publicly traded insurance players, such as Berkshire Hathaway, Allstate, China Life Insurance, American International, and these are all publicly traded on the New York Stock Exchange, we see that most of these guys trade at a price to sales of 1 or lower, with Berkshire Hathaway being the highest price to sales, and that's a price to sales of 2. So for Lemonade to trade at 11.4 price to sales in 5 years, that means either A, they need to be super profitable, because for a company to trade at a premium in price to sales, they really need to be profitable, or B, they still need to be growing at a super fast rate. So what does this mean for us? I'd say in conclusion, Lemonade's a very tricky company to value, right? There's a lot going on, a lot in the industry, a lot of new numbers for me, but I did my best, and at today's prices, I just don't see it worth being the investment, and let me explain why. So the main reason I don't think the stock is a buy is because when we assume a really optimistic case of gross earned premium growing 80% for the next 5 years. Now think about that. That's the average 80% growth. We're considering that not dropping hardly at all. And we saw that their gross earned premium dropped from 154% to 104% in a matter of a year. And we're just assuming an 80% flatline growth. So I'd say that's really optimistic. When we do that, we double their stock price, we still end up with an 11.4 price to sales, which is still really expensive. So that means on top of that assumption of them growing 80% year over year for 5 years, on top of that, we have to assume they're still growing really quickly or they're really profitable, because otherwise they wouldn't trade at that 11.4 premium versus their competitors who maybe have a 1 or 2 price to sales. So for me, I don't think the stock is a buy at this price. Based on those numbers that we ran, I gave a really bullish case, and the numbers just didn't really work out. We'll see what the stock price does in the short term. If you guys liked today's video, it took a lot of time, so please drop a like. And in the last video, I got a lot of dislikes, so we'll see what happens with CleanSpark stock. I could be completely wrong there as well. But if you liked the video and you thought it was educational, please give a thumbs up and consider subscribing. And other than that, everybody have a great day.